It's the moon! Moon! Look at the moon! Let's go to the moon! Welcome back, everybody. We gotta talk about some insane happenings that are going on with GameStop. As you can see, this beautiful, delicious baby, this hot stock, is up 32.5% in the after hours. Why? What could have happened? Well, is this the short squeeze that we've all been praying for? Especially me. Or is this potentially an actual positive adjustment based on fundamentals? I think, personally, this is based on fundamentals. This is not the forsworn, foretold short squeeze that everybody's telling me about. Let's go look and see what happened. Well, it looks like they reported results today. It's the 21st of March as I'm making this video, and this report is March 21st, 2023. So GameStop reported their fourth quarter and fiscal year 2022 results. On this channel, we actually look at the financials, okay? We don't just pray to the moon gods to 10x our index in 5 seconds based on some weirdo on the internet. So let's go look at some of the earnings. Net sales were $2.2 billion for the fourth quarter compared to $2.2 billion in the prior year's fourth quarter. So sales over the holiday season were flat, especially during an inflationary environment. Interesting. Selling, general, and administrative expenses were $453 million, or 20% of sales, compared to 24% of sales. So they actually cut their selling, general, and administrative expenses by a decent amount, which is a good thing. So even though their revenue by revenue stayed flat, they cut their selling, general, and administrative expenses by about 3.5%. Pretty good. Net income was $48 million compared to a net loss of $147 million for the prior year's fourth quarter. Net income. That means they had a profit on the accrual basis of accounting. We're going to go look at the financials and see if this was a one-time thing or if this is based on cost savings initiatives by the company. We'll see. Inventory was $682 million at the close of the period. This is on the balance sheet, compared to $915 million at the close of the prior year's fourth quarter, reflecting the company's ongoing focus on maintaining a healthy inventory position. Okay, I'll give them credit for that. And they have a decent amount of cash, $1.4 billion on the balance sheet. That's great, okay? Now, overall, net sales for the full year, the full 52 weeks, is down. Their revenue in 2021 was $6 billion. Now it's $5.9 billion. And if we look at the overall trend of this company, look at it from an annual perspective, we can see that their revenues are massively declining. Okay, they may have had some kind of divestiture here, but over time, their revenues have collapsed. And compared to 2022, their revenues have gone up. But they're basically not growing from a revenue perspective, okay? Doesn't mean the business is worthless, but they are growing. They're not this massively expanding growth stock that everybody thinks they are, or maybe they don't. But let's go ahead and look at the financial statements, okay? Because these always tell the real story. So here's the quarterly income statement. We could see revenue is flat, but cost of sales, the cost of the stuff they're buying and selling, the games, the blah, 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 has actually gone down. So they improved their gross profit by $20 million. $120 million improvement. That's a pretty good move towards profitability. They also cut their selling, general, and admin expenses, as we talked about, and they didn't have any, well, they had very, very, very few asset impairments, which is just writing down the value of an asset. There's a whole process you go through to see if an asset on your balance sheet is actually worth reflecting what it should be on the balance sheet. And if it's worth less, based on this whole process, you write it down. So they actually had positive operating earnings. These are all from improvements in managing expenses. This isn't just like a one-time thing. This is actually a pretty good change in the company's fortunes. Even though they're not growing their revenue, they're not a massively expanding 10x growth stock, they did increase their operating earnings. Okay? Now, you may compare it to like quarter over quarter and say, but look, bro, their revenue went up so massively quarter over quarter. Yeah, it's called the holidays, okay? It's all about the holidays. You sell a bunch of stuff during the holidays. Makes sense? This doesn't mean that they're just massively growing their revenue because they went up quarter over quarter. So, overall, they had net income of $48 million. That's pretty good, with earnings per share of 16 cents. Okay, you can't fault them for that too much, right? So, like I said, it's all about expense management. Now, if we go look on the balance sheet, we can see some interesting stuff. So first of all, they have total assets, total current assets, liquid assets of $2.3 billion compared to $1.3 billion of current liabilities. They're not imminently going to go bankrupt, in my humble opinion. They have plenty of cash and marketable securities and receivables, which it seems like they're saying they can collect the vast majority of them. And those can be used to pay their current debts. Now, long-term assets, they have mostly leases. They actually don't seem to own a lot of property, plant, equipment. Well, actually, no, they have a lot of accumulated depreciation. They have very old property, plant, and equipment. Now, I'm curious, now that I'm looking at this, are they going to replace their stores? Because they have a lot of accumulated depreciation, which means that they've, whatever buildings or infrastructure they've bought, they've used up a lot of it, okay? It's about due for some replacement. What are they going to do with it? I don't know, but that's a concerning thing that I see right there. Their lease, they have some leases, a little bit of deferred income taxes, and other non-current assets. So overall, their assets, they seem okay. I mean, we look at their long-term liabilities, they have $28 million of long-term debt, lease liabilities, and other long-term liabilities. They don't have a ton of long-term debt, okay? Now, overall, their stockholders' equity has gone down. Why is that? Well, for the full year, they haven't been profitable. For this quarter, they have. For the full year, they have not. So overall, the company has destroyed a decent amount of equity. But if they can start staying or continue to stay profitable, they might do okay. Now, if we look at the statement of cash flows, they have the 13 weeks ended January 28th, 2023. We can see that they're reconciling, they're adding back non-cash expenses, they're subtracting non-cash gains. Gain on sale of digital assets. That's interesting. Do they have crypto or Dogecoin, bro? And digital asset impairments. So that washed itself out. Stock-based compensation, blah, 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 blah. Okay? And then we have changes in working capital. So overall, they had a positive 338 of positive operating cash flows. That's pretty good, right? What do they use that money for? A little bit of capital expenditures. They park some of it in marketable securities. They're basically swapping out marketable securities. Nothing really crazy. Okay, they sold digital assets. I guess they sold their Dogecoin for $4.5 million. I wonder how much they paid for it. And I'm just guessing it's Dogecoin. I'm not sure what they bought, but it was some kind of clownish cryptocurrency, I can guarantee. Or maybe it was NFTs. I don't know. But overall, nothing too crazy for the last 13 weeks. Okay, positive operating cash flow. No crazy expenditures. I don't see any huge problems. Now, for the full year ended January 28th, 2023, we can see that they had pretty significant digital asset impairments, okay? Whatever they bought, they lost a lot of money on, which is absolutely ridiculous, okay? Why, whatever they bought, why? Why are you doing that, okay? But whatever. So overall, for the full year, they had $108 million of positive operating cash flow. And it looks like they sold all of their digital assets. So overall, like, I mean, yeah, you got to look at the company from a holistic perspective. Sure, it's a low revenue, well, it's a negative revenue growing company. The revenue is declining. Very slowly but surely, this company is getting squeezed. It's getting squeezed out of the market. But that doesn't mean a company's worthless if it has profits. And you can take those profits, and as an investor, you can be a partial owner of those profits. So overall, I mean, I can't really take a dump on GameStop too much. It's actually better off, in my opinion, than AMC. Really? AMC is just an absolute dilution disaster. I don't see an imminent dilution with GameStop unless they really have this sudden desire to, or requirement to turn over a lot of their property, plant, and equipment, because they have exhausted a lot of their PP&E. So they're going to need some money some way, either through debt or through an equity issuance, to replace these assets, these long-term assets, if they even need to do it at all. But overall, if you compare this to GME or AMC, this is way better. So, I mean, I'll give it to the GME shills. This was not a bad quarter. Not a bad quarter. Company still ain't doing that great. It's not growing. But at least they're making money now, which is an interesting proposition. Hope you enjoyed the video. Hope you learned something. And oh my God, it's going to the moon, right? No, it's just because they had good earnings, okay? Talk to you later. Cheers.